Disclaimer.
While most people are watching the headlines, the clock on the wall of global finance has started a countdown that cannot be stopped. We have 90 days before the cracks in the dollar system become a canyon. But history teaches us one thing: where paper promises fail, the era of hard assets is born. Today, I'm going to show you the data that explains why silver isn't just an investment. It's your final exit plan. And that countdown started with something that happened on January 1st, 2026, something that almost nobody in America noticed. While we were celebrating the new year, China quietly flipped a switch that cut hundreds of silver suppliers out of the global market overnight. New export restrictions went into effect, requiring companies to have at least 80 tons of annual production capacity and special government licenses just to ship refined silver out of the country. Small and mid-sized exporters, the ones who had been plugging gaps in global supply for years, suddenly found themselves locked out. Now here's what should grab your attention. This didn't happen in isolation. It happened at the exact moment when a parallel payment system, one that completely bypasses the dollar, crossed a critical threshold. And if you're holding any savings, any retirement accounts, any investments denominated in dollars, what I'm about to show you matters more than almost anything else happening in financial markets right now. Let me put this in perspective. Your 401k, your savings, your purchasing power, all of it is denominated in dollars. But here's what most Americans don't realize. The infrastructure that has kept the dollar at the center of global trade for 80 years is being quietly replaced, and the timeline just accelerated dramatically. You've probably heard about Mbridge, maybe you haven't. Either way, what matters is what it actually does. This is a cross-border payment system built on blockchain technology that allows countries to settle trade directly in their own digital currencies, completely bypassing both the dollar and the SWIFT network that America has used as financial leverage for decades. According to Ledger Insights, Mbridge has now processed over $55 billion worth of transactions, with 95% of those payments flowing through China's digital yuan. But here's where it gets interesting. The Bank for International Settlements, the central bank of central banks, actually withdrew from managing Mbridge in October 2024. They handed control directly to the participating central banks. Why? Because BRICS nations had already announced plans to build their own version called Bridge, and the BIS couldn't be seen supporting a system designed to route around American financial oversight. So now Mbridge operates independently, managed by China, Thailand, Hong Kong, the UAE, and Saudi Arabia, with India just adding BRICS CBDC Bridge to their 2026 chairmanship agenda. And Saudi Arabia's participation is the detail that should keep you up at night. For 50 years, the petrodollar system has been the foundation of American financial dominance. Saudi Arabia sells oil, the world pays in dollars, those dollars get recycled into US treasuries, and America gets to run deficits that would bankrupt any other nation. But now, Saudi Arabia sits on the Mbridge steering committee. They have the infrastructure to accept yuan, dirhams, or any other digital currency for oil settlements. The first quarterly oil sales settled through Mbridge will clear by March 2026. And when that data becomes public, markets will finally have hard numbers on exactly how much energy trade is now flowing outside the dollar system. Pop quiz. What do you think happens to demand for dollars when the world's largest oil exporters can settle energy trades in their own currencies? What happens when the infrastructure to bypass SWIFT isn't theoretical anymore, but actually processing real commercial transactions in real time? The answer is playing out right now in precious metals markets, and silver is at the center of it. In late January 2026, silver did something it had never done before. It crossed $100 per ounce, then kept climbing past $110. For a metal that was trading around $30 just 12 months earlier, this was an almost vertical move. And then, within days, it crashed nearly 50%. Headlines screamed about speculation and bubbles bursting. Treasury Secretary Scott Bessent blamed Chinese traders for driving extreme volatility. But here's what those headlines missed entirely. The physical shortage that drove silver to those highs hasn't changed at all. What unwound wasn't demand for real metal. It was leveraged paper positions that got squeezed when prices moved too fast. The speculative froth blew off, but the structural deficit underneath remains exactly where it was. Think about what that means for a moment. Silver today is trading around $82 per ounce. That's down significantly from the January peak, which makes it feel like the opportunity passed, but it's also more than double where it sat 1 year ago. And the conditions that drove that initial surge, the supply constraints, the industrial demand, the monetary instability, none of those have resolved. If anything, they've intensified. Let me show you the connection that most analysts are missing. China didn't implement silver export restrictions at random. The timing aligns precisely with the operational expansion of alternative payment systems. When you can settle trade without dollars, you don't need to hold dollars in reserve. When you don't need dollar reserves, you need something else to anchor your currency's credibility. Throughout history, that something else has been gold and silver. According to the World Gold Council, central banks purchased 863 tons of gold in 2025 alone. That's historically elevated, even though it's down slightly from the record-breaking pace of previous years. But here's the detail that matters. And 95% of central banks surveyed expect global gold reserves to keep growing over the next 12 months. That's the highest level of institutional optimism the survey has ever recorded. These aren't retail investors chasing momentum. These are the people who manage national monetary systems, telling us exactly where they think value is heading. Now, silver operates differently than gold, and this is crucial to understand. Gold mostly sits in vaults. Central banks accumulate it, store it, and hold it as a reserve asset. Silver gets consumed. It goes into solar panels that generate electricity for decades. It becomes part of circuit boards and smartphones and data centers. Medical instruments rely on its antibacterial properties. And once it's embedded in these products, it's essentially gone from the market because recovering and recycling it costs more than mining new supply. According to the Silver Institute, global silver demand reached over 1.2 billion ounces in recent years, while total supply, including mining and recycling, only produced around 1 billion ounces. That's a structural deficit of over 200 million ounces annually, equivalent to the entire yearly output of Mexico, the world's largest silver producer. And this deficit has been running for 5 consecutive years now, with cumulative shortfalls approaching 820 million ounces since 2021. Let me put that number in context. Global mine production sits around 813 million ounces per year. The cumulative deficit we've built up is essentially an entire year of production that's been drained from above-ground inventories and consumed by industry. Those missing ounces aren't coming back. They're in solar panels on rooftops in Germany. They're in servers powering AI data centers. They're in electric vehicles rolling off assembly lines in China and America. Physical inventories tell the story clearly. Shanghai Exchange stocks fell to their lowest level since 2015. London vaults, a key storage center for ETFs and industrial users, saw significant drawdowns as metal flowed to India and Asia. Lease rates for silver spiked above 5% multiple times in 2025, well above the historical norm of near zero. When holders of physical bullion start demanding premiums just to lend their metal, that's a signal of genuine scarcity, not paper speculation. There's another technical signal that professionals watch closely. In normal markets, futures contracts for delivery months away trade at a slight premium to near-term contracts, reflecting storage and financing costs. But starting in late 2025, silver's futures curve flipped into what traders call backwardation. Nearby contracts became more expensive than deferred ones. In plain English, the market is saying that silver you can take delivery of right now is worth more than silver promised months in the future. That's not speculation. That's the market admitting it doesn't know if there will be enough metal to deliver. So here's the question we need to ask ourselves. If the dollar's role in global trade is being systematically reduced through new payment infrastructure, and if central banks are responding by accumulating hard assets at record pace, and if silver specifically faces a structural supply deficit that cannot be quickly resolved, what does that mean for the price you'll pay for this metal 6 months from now? 12 months from now? The January spike to $111 wasn't the end of the story. Based on everything happening in monetary systems right now, it might have been just the opening chapter. Now let me show you the evidence that institutions are acting on but not talking about publicly. Because while headlines focus on daily price swings, the real story is playing out in Treasury holdings, central bank vaults, and official reserve data that most Americans never see. Start with this question. Where is the money going when it leaves the dollar system? The Treasury International Capital data from the U.S. Department of Treasury gives us a clear answer. As of late 2025, Japan remains the largest foreign holder of U.S. debt at around $1.2 trillion. But look at what BRICS nations have been doing. China's Treasury holdings dropped to $757 billion, down from over $900 billion just a few years earlier, a reduction of more than 11%. Brazil cut holdings by 27%. India reduced by 20%. These aren't portfolio adjustments. This is coordinated movement away from dollar-denominated assets. And here's the part that should concern every American holding dollar-based investments. According to Visual Capitalist's analysis of the latest data, gold's share of global central bank reserves has now surpassed U.S. dollar allocations for the first time since the early 1970s. Think about what that means. The institutions that manage national monetary systems, the people with the most sophisticated analysis and the longest time horizons, have collectively decided that gold is a better store of value than the currency we use every day. Poland's central bank has been one of the most aggressive buyers, adding 102 tons in 2025 alone and pushing gold to 28% of total reserves. Their governor announced intentions to increase holdings to 700 tons, citing national security reasons. Not economic optimization, national security. When central bankers start talking about gold in terms of national survival rather than portfolio diversification, that tells you something fundamental has shifted in how monetary authorities view the global financial system. Kazakhstan set a record for annual gold purchases at 57 tons, the highest level in their data going back to 1993. The Czech National Bank maintained steady accumulation throughout the year. Turkey continued aggressive buying despite domestic economic challenges. And perhaps most significantly, Reuters reported that the Bank of Korea was considering gold purchases for the first time in many years, potentially adding another major economy to the buying wave. The World Gold Council's 2025 survey found that a record 43% of central banks plan to increase their gold holdings in the coming year, with none anticipating reductions. But here's where silver enters the picture in a way most analysts miss entirely. Gold is the monetary metal. Central banks buy it for reserves. Silver is the industrial metal that also happens to have monetary properties. And that dual nature creates a setup unlike anything we've seen in financial history. To understand why, we need to go back to 1971. August 15th of that year, President Nixon appeared on television and announced that the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. This was supposed to be temporary. It wasn't. The gold window closed permanently, and the dollar became a pure fiat currency backed by nothing but confidence in the U.S. government. What happened next is instructive. In the decade following the Nixon shock, gold went from $35 to over $800 per ounce, a 22-fold increase. But silver did even better. It went from around $150 to $50 per ounce, a 33-fold multiplication. The people who recognized the monetary transition early and positioned in hard assets didn't just preserve wealth, they multiplied it many times over. Now here's why the current setup is potentially more explosive than 1971. Back then, silver was primarily a monetary and jewelry metal. Industrial demand existed but wasn't dominant. Today, according to the Silver Institute, industrial applications consume over 665 million ounces annually, more than half of total demand. Solar panels alone require approximately 100 million ounces per year, and that number is growing as countries race to meet renewable energy targets. Think about the math here. Every solar installation, every electric vehicle battery, every smartphone, every data center server, they all require silver. And unlike gold, which sits in vaults maintaining its value across generations, silver gets consumed. It gets embedded in products where recovery isn't economically viable. The metal that was already in structural deficit is now facing accelerating demand from the fastest growing sectors of the global economy. Consider what's happening right now in artificial intelligence. Every AI query, every ChatGPT response, every image generation runs through servers packed with silver-containing components. Data centers are expanding at unprecedented rates to meet AI demand, and each facility requires substantial quantities of silver for electrical contacts, thermal management, and circuit boards. The semiconductor industry alone consumed over 100 million ounces in recent years, and that number grows as chips become more complex and AI infrastructure scales globally. Electric vehicles present another layer of demand that didn't exist a decade ago. Each EV contains approximately 25 to 50 grams of silver in its electrical systems, battery connections, and charging infrastructure. With global EV sales pushing toward 20 million units annually and major automakers committed to electrification, the automotive sector alone could require an additional 30 to 50 million ounces per year by the end of the decade. The International Energy Agency projects solar capacity to quadruple by 2030. That's not speculation. That's infrastructure already being built, contracts already signed, factories already producing panels. Each of those panels needs silver, and there simply isn't enough supply coming online to meet that demand. Let me walk you through the supply side, because this is where the situation becomes mathematically impossible to ignore. Global silver mine production peaked in 2016 at around 900 million ounces. By 2025, it had declined to approximately 813 million ounces. Ore grades have fallen at mature operations. Regulatory challenges have slowed new project development in major producing countries like Mexico, Peru, and Bolivia. And here's the critical detail. Approximately 71% of mined silver comes as a byproduct from gold, copper, lead, and zinc operations. Miners can't simply increase silver production in response to higher prices because their primary economics are driven by other metals. Recycling contributes another 180 to 190 million ounces annually, but that number has remained essentially flat for years. The silver embedded in solar panels, electronics, and industrial applications is too dispersed and the quantities too small per unit to make recovery cost-effective at current prices. So add it up. Demand exceeding 1.2 billion ounces, supply around 1 billion ounces, annual deficit over 200 million ounces. And this has been running for 5 consecutive years, draining above-ground inventories that took decades to accumulate. In the 1970s, the silver squeeze happened purely because of monetary instability. Investors fled the dollar and poured into hard assets. Today, we have that same monetary instability. Central banks abandoning dollar reserves, alternative payment systems going live, fiscal deficits exceeding $1.8 trillion annually. But we also have industrial demand that didn't exist 50 years ago. The 1970s gave us a 33x move in silver. The current setup has the same monetary drivers, plus a structural supply deficit, plus accelerating industrial consumption. The question isn't whether silver prices will rise. The question is how high they go when paper markets finally reconcile with physical reality. And that reconciliation may be closer than most people think. The January 2026 spike to $111 showed what happens when even a fraction of investment capital tries to find physical metal. The crash that followed showed what happens when leverage positions unwind. But the underlying deficit didn't change. The industrial demand didn't pause. The central bank buying didn't stop. What we witnessed in January wasn't a bubble bursting. It was a preview of what happens when paper promises meet physical scarcity. The market gave us a glimpse of where prices need to go, then pulled back to let latecomers catch up. The infrastructure for the next move higher is already in place. So let's talk numbers. Not theoretical projections or wishful thinking, but the actual prices, targets, and timelines that institutional analysts are publishing right now. Because if you're watching this on February 15th, 2026, the window we've been discussing is about halfway closed. Silver closed yesterday around $82 to $85 per ounce, depending on which quote you're looking at. That's roughly 30% below the January 29th peak of $111.36, but still more than 160% higher than where it traded 12 months ago in the low $30 range. Gold is hovering around $5,500 per ounce, having briefly touched $5,700 earlier this month after surging 27% in January alone. The U.S. national debt has crossed $38.6 trillion. Fiscal 2025's deficit came in at $1.8 trillion. And interest payments on that debt now exceed what we spend on national defense. Those are the baseline numbers. Now let's look at where analysts expect things to go. BNP Paribas, one of Europe's largest banks, has published a target of $100 per ounce for silver by the end of 2026. Their thesis centers on persistent physical shortages and safe haven demand amid ongoing geopolitical uncertainty. That's a roughly 20% move from current levels, which might sound modest until you remember that most asset classes consider 8 to 10% annual returns exceptional. But other analysts see significantly higher potential. Peter Krauth of Silver Stock Investor has published research suggesting silver could break $125 per ounce this year, with the primary catalyst being what he calls a potential force majeure event on the Shanghai exchanges. In plain terms, that means a scenario where the exchange cannot deliver physical metal to satisfy futures contracts, forcing a cash settlement at prices determined by desperate buyers rather than orderly markets. If Shanghai inventories, already at their lowest since 2015, continue declining while demand remains elevated, that scenario becomes increasingly plausible. JP Morgan's commodities team projects gold, reaching $5,000 by the fourth quarter of 2026, with potential extension to $6,000 in the following years. They expect central bank purchases to remain elevated at around 755 tons annually, down from the peak of over 1,000 tons in recent years, but still nearly double the pre-2022 average. Their outlook explicitly states that traditional models, based on real interest rates, are failing to capture gold's current behavior, suggesting structural changes in how markets value monetary metals. Now, here's a calculation that almost nobody is discussing publicly. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, currently sits around 65 to 68. Historically, this ratio has ranged from 15 in periods of silver scarcity to over 100 during silver bear markets. The geological ratio of silver to gold in the Earth's crust is approximately 17 to 1. During the 1980 peak, the ratio compressed to around 17. During the 2011 silver high, it reached 32. If gold maintains current levels around $5,500, and the ratio merely returns to its 2011 level of 32, that implies silver at $172 per ounce. If the ratio compresses further toward historical extremes, the math gets even more dramatic. This isn't prediction, it's arithmetic based on historical precedent and current gold prices. But let's focus on what's happening right now in real time, because the 90-day countdown I mentioned at the start has a specific endpoint. The first quarter of 2026 marks when Saudi Arabia's initial oil settlements through Mbridge will clear and become visible in trade data. By late March, markets will have hard evidence showing exactly what percentage of Middle Eastern energy trade is now flowing outside the dollar system. Current estimates suggest Russia-China trade has already shifted dramatically, with dollar usage falling from 96% in 2020 to under 15% today. If Saudi data shows even a 10 to 15% shift toward non-dollar settlement, That represents a fundamental break in the petrodollar arrangement that has underpinned American financial dominance for half a century. The implications for precious metals are straightforward. Every country reducing dollar reserves needs alternative stores of value. Gold is the obvious choice for central banks, but gold at $5,500 per ounce requires massive capital commitments. Silver offers the same monetary properties at a fraction of the price, making it accessible to smaller institutions, sovereign wealth funds, and individual investors seeking hard asset exposure. There's another timeline that professional traders are watching closely. China's silver export restrictions went into effect January 1st. The full impact of those restrictions won't become apparent until Q1 trade data is published, likely in April. If global buyers who previously sourced refined silver from Chinese suppliers find themselves unable to secure physical metal, the inventory drawdowns we've already seen will accelerate dramatically. Remember, the cumulative deficit from 2021 through 2025 totaled approximately 820 million ounces. Analysts project 2026's deficit at another 200 million ounces, potentially making it the worst shortfall in the current cycle. That brings cumulative missing supply above 1 billion ounces, more than an entire year of global mine production that has been permanently consumed and cannot be recovered. Now, let me address the bearish case directly, because you deserve to hear both sides. Marko Kolanovic, formerly JP Morgan's chief strategist, has publicly stated he expects silver to trade back toward $50 per ounce, roughly half current levels. His thesis centers on the argument that silver's recent behavior resembles speculative excess rather than fundamental repricing. He points to the historic volatility, the rapid unwind of leveraged positions, and silver's track record of punishing late buyers. He's not wrong about the volatility. Silver has routinely crashed 70 to 90% after major rallies throughout its history. The January sell-off from $111 to around $75 demonstrated exactly how quickly gains can evaporate when momentum reverses. But here's what the bearish case misses. Previous silver crashes occurred when supply was adequate to meet demand. The 1980 crash happened after the Hunt brothers squeeze failed and industrial demand was minimal. The 2011 correction came during a period when mining supply was still expanding and solar demand was nascent. Today, we have 5 consecutive years of structural deficits, accelerating industrial consumption from solar and EVs and AI, Chinese export restrictions, limiting global supply, and central banks systematically reducing dollar reserves in favor of hard assets. The conditions that enabled previous crashes don't exist in 2026. So what should you actually do with this information? Let me be direct. I'm not a financial advisor, and nothing I'm saying should be construed as investment advice for your specific situation. But I can share what the data suggests and what institutional actors are actually doing with their capital. Central banks collectively purchased 863 tons of gold last year. ETF inflows hit 801 tons, the second strongest annual increase on record. Bar and coin demand reached a 12-year high. These are not retail speculators chasing momentum. These are the most sophisticated institutions in global finance, systematically increasing hard asset exposure while reducing dollar holdings. The question you need to ask yourself is simple. Do you want to be positioned ahead of this transition, or do you want to watch it happen from the sidelines? Silver at $82 per ounce isn't cheap compared to where it was 12 months ago. But if the structural deficit continues, if Mbridge expansion accelerates the decline in dollar demand, if central bank buying persists at elevated levels, then $82 might look like a bargain compared to where prices stand 6 months from now. The clock is ticking. The 90-day window ends around late March when the first hard data on Mbridge oil settlements becomes public. Between now and then, the market is essentially guessing about how fast the dollar's reserve roll is actually eroding. Once that data arrives, guesswork becomes fact, and prices will adjust accordingly. Every major monetary transition in history has followed a similar pattern. First, institutions recognize the shift and begin repositioning quietly. Then, early adopters among sophisticated investors follow. Then, mainstream awareness builds, creating a rush that drives prices far beyond what fundamentals alone would justify. Finally, the transition completes and a new equilibrium establishes. Right now, we're somewhere between stages 1 and 2. Central banks have been buying gold for over 3 years at record pace. Institutional investors have begun increasing precious metals allocations. But mainstream awareness remains limited. Most Americans still think of gold and silver as speculative commodities rather than monetary insurance. That gap between institutional action and public awareness represents the opportunity. The data I've shared today isn't secret. It's published in official reports from the World Gold Council, the Silver Institute, the U.S. Treasury, and major financial institutions. But it's scattered across dozens of sources and rarely connected into a coherent narrative. Now you have that narrative. What you do with it is up to you. The countdown continues. The deficits compound. The payment systems expand. And silver, the metal that humans have used as money for 5,000 years, is once again positioned at the center of a monetary transformation that will reshape how wealth is measured and preserved for generations to come. History doesn't repeat, but it rhymes. In 1971, those who recognized the Nixon shock and positioned in hard assets saw their purchasing power multiply while everyone else watched theirs erode. In 2026, the shock is quieter. No presidential address interrupting television programs. But the implications may be even more profound. The dollar replacement system isn't coming. It's already here. The question is whether you'll act on that knowledge while the window remains open, or wait until the headlines make it impossible to ignore. By then, of course, the opportunity will have passed. This is your chance to be early. Don't waste it.